Strategic non-engagement. Why not expanding branches might be your most profitable and sustainable strategy in an era of volatility. The strategy for wealth creation and impact in the global economy of 2026 is shifting from an era of mass expansion, focused on pouring resources into tangible assets, to one of architectural power. This demands prudent and visionary thinking in resource allocation. The core principle is strategic non-engagement, a refusal to enter frivolous, low-return competitive arenas. Choosing not to fight in highly contested red ocean markets allows leaders to conserve ammunition or resources to achieve victory in unseen territories. Data from McKinsey and Company confirms that companies employing dynamic resource allocation strategies, daring to divest from low-margin business units to concentrate resources on structurally advantageous areas, have a 30% higher total return to shareholders, TRS, over the long term compared to those attempting to maintain every foothold. At the macro level, major powers and emerging economies are adapting to this strategy to navigate supply chain volatility and geopolitical conflicts. A clear example is the shift by G7 and ASEAN nations from global integration to friendshoring, especially in the semiconductors industry. ASEAN has become a critical battleground due to the need to diversify risk from traditional manufacturing bases in China and Taiwan. Malaysia, Vietnam, and Thailand's focus on chip manufacturing and upstream technologies isn't merely about cheap labor, it's a strategic move to control an empire of intellectual property, IP, and digital infrastructure. This shields them from trade protectionism and builds new leverage in the global supply chain, fostering strategic agility. This agility means that in the face of tax fluctuations or disputes, businesses prioritizing systems and intellectual property can instantly relocate processing bases or switch partners, unlike businesses burdened with heavy factories that become economic hostages. This strategy of selecting battlegrounds also significantly adapts to the demographic structure of each nation. Aging societies, e.g., Japan, Thailand, Singapore, these nations critically need scaling deep and up strategies. Unable to rely on large labor forces, they must emphasize value creation through automation, allowing systems and intellectual property to perform tasks traditionally done by people. Nations with large working populations, e.g., India is deploying a digital stack strategy, building digital infrastructure to provide its massive population with simultaneous access to financial and educational systems. This bypasses the limitations of slow physical branch expansion, transforming India into a new economic powerhouse through the power of platform systems. Historically, businesses often fell into the trap of scaling out by increasing the number of branches, believing market presence was key to success. However, data from Deloitte indicates that 40% of current branch expansions suffer from cannibalization and bear escalating fixed costs, rent, management expenses, and operational risks due to inflation. Strategic non-engagement is therefore a refusal to be a hamster on a wheel, preserving resources to build scaling through platforms. This aligns with OECD reports stating that businesses investing in intangible assets, such as intellectual property and data architecture, demonstrate a productivity growth rate twice as high as physical businesses. The core of organizational growth without physical expansion lies in establishing the commander's intent. This involves embedding decision logic into systems or AI, allowing the business to expand while the owner's quality of thought remains pervasive across the platform, even without their direct command. This concept aligns with the essence of a startup at the level of scalability, enabling systems to support exponential growth with near-zero marginal cost. Consider a SaaS, software as a service, for a dormitory management business or a coffee shop business. Instead of expanding physically, they could develop a subscription model or license their proprietary recipes, protected as intellectual property, to grow without adding fixed assets, asset-light. For the manufacturing sector, a precise and sophisticated strategy isn't about merely building larger factories. It's about transforming from an OEM, original equipment manufacturer, to an owner of structural innovation. Building strengths and addressing weaknesses. The weakness of manufacturing lies in its capital-intensive nature, vulnerable to fluctuating energy and labor costs. The solution is modular manufacturing, investing in flexible production technologies and designing standardized parts usable across multiple products. This enables factories to produce a greater variety without expanding physical space. Creating an intangible mode. This involves transforming factories into a manufacturing as a service (MaaS) platform. When partners integrate into your digital system and adopt your manufacturing standards, your intellectual property, they find it difficult to leave, as your system effectively becomes their business's operating system. The art of strategy, however, the true art of strategy must adapt to the nature of the business. Physical touch businesses, e.g., cosmetic clinics, fine dining restaurants, these should halt self-managed branch expansion and instead develop a central kitchen or standardized training center. Hybrid businesses in this sector show a 20% higher net profit margin than traditional, branch-focused ones. Euromonitor. Professional services, e.g., law firms, accounting consultants, instead of hiring more staff, which often leads to inconsistent quality. The focus should be on creating standardized processes or AI tools that empower a single expert to manage 5 to 10 times more complex tasks efficiently. Winning in the unseen competitive arena means transforming from a player to a rule maker. A prime example is a vocational training school that becomes a certification body, issuing professional standards for other schools to adopt instead of opening new branches. This allows the business to penetrate every market without a single brick-and-mortar presence, accumulating resources where competitors cannot see or interfere. It's not a competition of visibility, but one of systemic power, fortified by intellectual property. Ultimately, the greatest victory in today's global economy isn't measured by the number of branches or fleeting media fame. It's measured by the ability to centrally manage resources from a control tower through robust, flexible infrastructure. This builds a foundation safe from external volatility and ensures lasting value for future generations.